This major currency is collapsing and it could take down the US economy. And let us head all the way to Tokyo, Japan, where something tragic is happening, but no one really is paying attention to it. The Japanese yen, which is the world's third largest reserve currency, is getting clobbered, and the more it crashes to hell, the more US treasuries Japan has to dump. Putting up a chart of the yen, it has crashed by over 11.5% to the greenback this year alone. Japan is selling off their pile of dollars to defend the yen, but it isn't working. And this is a crisis because Japan relies on a ton of foreign imports. They're bringing tons of food, they're bringing tons of fuel, plus a ton of inputs for manufacturing. And guess what those are priced in? US dollars. So as the yen continues to collapse, the cost of living in Japan is going to fly up. However, the big casualty of this will be the US Treasury markets. Japan will have to keep dumping their bonds to raise cash to defend the yen, but that's just the preview. Once Japan reverses course on their money printing adventure, that could really cause the US bond market to implode. We know China's treasury sell-off is intentional, but Japan's dump is purely due to economic reasons, and this train has left the station. If we look at Japan's bond holdings, it's really shocking. They are the only G7 nation selling. In fact, they sold over $127 billion worth, which is more than China's own treasury dump. And this sell-off isn't going to stop because Japan has lost control of their currency. Even if they reverse course tomorrow, US treasuries are in big trouble. And if you need to blame someone, you gotta blame the Bank of Japan. They went to the same school of Twilight Zone economics as the Federal Reserve, except Japan graduated top of their class. Japan has been printing money for 6 years straight to keep bond yields down to stimulate their economy, right? The BOJ buys a ton of Japanese government bonds to push down the yields of the 10-year. So if yields look like they are about to break through the upper limit of 0.5%, they will activate the money printers to buy up a boatload of bonds. It's the same thing the Federal Reserve did back in '08 and 2020. But even they knew there was a limit to this. But for Japan, there are no limits. Money printing is now the main strategy, and the main casualty is their currency, the yen. According to Goldman Sachs, the yen could crash back to 1990 levels if the BOJ keeps this up. The yen could crash another 20 points to 155 against the dollar. And this is going to cause a lot of pain for the people on the street. So Japan is in a silent inflation hell. I call it silent because our focus mainly revolves around the Western world. Inflation rates there are high, especially in Europe, but we need to focus on Japan. They have lost control. If we compare Japan's inflation rate with the United States, we can see a shocking trend. Inflation in both countries are neck and neck with each other. In fact, Japan's inflation hit 3.3% for June and July, which exceeded America's CPI rate for 2 months in a row. So Japan's money printing is working to drive up inflation. That is their end goal, but is it the right type of inflation? What the BOJ wants is wage inflation. They want salaries to rise higher so Japanese people can spend more and more to revive the zombie economy. But printing money is not the solution. It is an artificial measure that won't solve Japan's structural problems. They have a shrinking population and workforce. You can't print your way out of that mess. You'll only destroy the yen even further. Yen's buying power sinks to 53-year low after decades of stagnation. When we talk about currencies, what matters to the man on the street is purchasing power. How much stuff can you buy with your currency? That's all we care about. And in that respect, the yen has truly collapsed. In real terms, the yen's buying power has dropped from its peak in 1995 back down to the 1970s level. So even though the Japanese stock market, the Nikkei, is rising, it's not a symptom of a strong economy but a product of a weak currency. You have to pay more yen to buy stuff, including stocks and shares. The BOJ will of course push back saying that salaries are rising and people in Japan are earning more. On the surface, that might be true, the nominal amount is going up. But let's dig deeper and you'll realize that really doesn't matter when inflation is outpacing wages. In the report by Reuters, real wages have fallen for the 16th straight month in July. People are working more and more but earning less and less, and it all has to do with rising inflation and the yen crashing to hell. Japanese real wages extended their fall to a 16th consecutive month as salaries failed to keep up with rising prices. Things are taking an even darker turn. Japan's nominal wage growth is now slowing down. In June, wage growth was only 2.3%, but in the same month, inflation was 3.3%. So effectively, your real salary has gone down by at least 1%. Your money buys less stuff in the real world. Here's the big problem with weakening your currency by printing money. Japan isn't like the United States or China. The US is self sufficient in food and energy, plus, they hold a reserve currency they can print all they want, while China is getting subsidized commodities straight from Russia, so the impacts of inflation are contained. Japan, however, has to pay more and more for their imports, and this is destroying real wages. The country has a silent inflation crisis and people are panicking. So it isn't a surprise that people in Japan are running to gold. Local Japanese men, local Japanese women are taking their cash and throwing it at physical gold bullion. In a story from the FT, inflation worries fuel Japanese rush to buy gold. The retail price in Japan has reached 10,000 yen per gram, which is bonkers. Even though gold is bouncing around in US dollar terms, it is rising in terms of yen. Remember the basics of gold. It is not that gold is gaining in value, it's simply the value of the currency is crashing. Gold is a barometer of currency failure. Since 2020, the price of gold in Japanese yen has been surging year after year. It has appreciated by 75% since the lows in 2020. And this shows you how much purchasing power has been lost in the local currency. Just think about it, guys. If you're the average Japanese investor, where else can you go? Real estate is still insanely expensive, and Japanese stocks are risky because the economy is not fundamentally strong. It is propped up by money printing. And this leaves us only two places: US Treasury bonds, the dollar, and gold. And that's why both the dollar index and gold price in yen are going up today. And if you are a gold investor in Japan, you are sitting on a ton of gains. Gold bucks in Japan reaping rewards as yen weakness persists. The price of gold has surged by 18% since January alone. This is driven by expensive stocks and huge ETF demand. So it isn't just the man on the street buying physical gold bars. Money is also being poured into gold ETFs, and this is a game changer. Mainstream investors are waking up and realizing that hey, inflation is here to stay. The Bank of Japan isn't reversing costs, and I need to hedge my buying power with some gold. And this is putting a support on the international price of gold. We can confirm this with gold ETF flows coming from Japan. While Western gold ETFs are selling off, Japan is still furiously buying in. And this is countering all the selling pressure coming from the West. Gold demand in the East is starting to decouple from the Western markets. And this is where we need to talk about the Bank of Japan because they are trapped in a dilemma. They don't dare hike rates further because it might implode this house of cards, right? But they have to eventually. And this will be the most dangerous pivot in the world. The Bank of Japan is essentially fighting a losing battle which they can't win. Firstly, inflation in the United States has rebounded. It has gone up from 3.2% in July to 3.7% in August. Core inflation has also increased from the previous month, and this is going to complicate the Federal Reserve's inflation fight. Even if Powell isn't going to hike further, he sure as hell is going to stay higher for longer. US interest rates aren't going to come down, and this is a big problem for Japan. Japan's current benchmark rate is still at its 2016 levels of minus 0.1. That is a negative interest rate, guys, which pushes investors and savers out of Japanese bonds. Comparatively, the Fed funds rate is at 5.5%, which lures in investors and money into the United States. No matter how bad the US economy is, their bond yields are way higher than Japan's, which is near zero. So all this cash is leaving Japan and flooding to places like gold and US treasuries. Investors bought over 100 billion in foreign debt in the first 6 months of 2023. The majority are US bonds because JGBs are effectively trash. The only buyer is the Bank of Japan, and that isn't genuine buying but interest rate intervention. But this situation will reverse because the BOJ doesn't have much excuse left to continue their yield curve control. There's no runway left. Printing money to buy bonds isn't effective anymore. And you would think that a cheaper yen would be great for exports, right? But unless you didn't notice, we are moving towards a global recession. Global demand for anything is crashing. Japan's exports actually fell by 0.3% in July. That marks the first time in 2.5 years. If a falling yen makes Japanese exports cheaper, their sales should be through the roof. But they didn't post a gain. In fact, it was a contraction in demand. Then you have weak orders coming in from manufacturers. Things are getting worse in Japanese industries. The orders from manufacturers fell by 5.3% in July, the largest decline in 8 months. The demand is simply not there. This is the big problem with trying to solve structural problems with monetary policy, right? Consumption demand across the US, China, and Europe are all dropping. No amount of money printing will solve this. You'll just crash your currency further and create a bigger inflation problem. And this means the Bank of Japan has to reverse course and high interest rates sooner or later. The BOJ is hinting that the end of their ultra easy policy is coming soon, and the longer this situation goes, the yen is going to keep collapsing further. But when this reversal happens, the big casualty might just be the US economy, and it will start in the bond market. And here's why. When the Bank of Japan raises interest rates, it creates a vacuuming effect. Japanese investors will start pulling their money out of US treasuries and they'll head back to Japanese government bonds. Now I know what you're thinking, right? How does this make sense? Even if the yields on Japanese bonds hits 1 or even 2%, US debt is still giving 4 or 5%. It's still a win to buy treasuries, right? Not really. We need to account for currency appreciation. When the Bank of Japan decides to hike rates, this will make the yen rise against the dollar. The economist Brett Setzer sums it up perfectly. If you're a Japanese investor and you bought US dollar bonds, the big risk you face is the yen will go up and the dollar will go down, and the yen value of your dollar bonds will go down. There's no point in getting a 5% yield when the dollar crashes 7 or 8% against the yen. You are losing 2 to 3% in absolute terms in your local currency. And the last time Japanese investors sold their US bonds, it accounted for the majority of the 6.3% decline. That's a huge amount. And that's why the Bank of Japan could be the black swan event that breaks the camel's back. We know that China is dumping treasuries and they likely won't buy anymore in the future. Now you pile on Japanese investors running away from the US debt market back to their local yen denominated bonds. That is a big problem for the US economy. Bond yields will be under immense upward pressure, especially when Congress can't stop spending, right? Remember that almost a third of US bonds are held by foreigners, both governments and private investors. If the Bank of Japan pivots away, we could see a ton of liquidity leave the treasury market and jack up the cost of borrowing for America. And we all know what that means, the high odds of a banking crisis and even a recession that is long overdue. So we have to brace for impact. We are facing a lose-lose scenario. Either the yen will collapse further or the treasury market is in trouble when the pivot finally happens. But let me know what you think in the comments below. Will the BOJ pivot soon? Or will they condemn the yen to a devaluation hell? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.